If someone presented 100 companies to you with varying revenue growth, profit margin, earnings, and asset to debt ratios, how many of them should you pick as an investment? Most financial advisors tend to say that you need to diversify your portfolio in order to reduce your risk. The truth is, if the 100 companies were from a similar industry, dependent on the same total addressable markets, and had few differentiating factors between them, this is not effective diversification, because they will be highly correlated in the stock market. How then should you diversify? Let's explore this now. Before we jump into the details, do note that I am not a licensed financial advisor and none of this is financial advice. We're simply presenting our research and opinions for fun and educational purposes. While it is true that well-diversified portfolios tend to be less volatile, meaning they fluctuate less during market rallies and crashes, do not confuse this with risk, because risk is the probability of something causing the company to decrease in growth or earnings, while volatility is just a measure of price action driven by Mr. Market's sentiment. Observe the best investors. Over long periods of time, they make concentrated bets on a few companies. While it is true that going all in on a single stock can be risky, it is important to note that the risk really depends on what you understand about the prospects of that business. I would argue that it is far safer to bet on a few companies that you have a solid grasp on how their business operates and how they can increase their earnings over time, rather than 100 different stocks, which you may barely understand. It is also a matter of practicality, as there's no way to automate everything in the realm of investing. You should consider the cost of your time to stay up to date with the companies that you invest in.
Time is money, friend.
Conventional wisdom says not to go beyond 40 stocks. Though I would also add that if you're new to investing, it might be better to start with 5 stocks or fewer. Of course, it depends on many other factors, such as how long it takes for you to research a company enough to form an opinion, how much money you have to invest, and your time horizon. In conclusion, asset allocation is not a science. Diversification may have a role to play in reducing the volatility in a portfolio, but I'd argue that if you have a long time horizon, say 5 to 10 years, and if you are able to find a great company at a reasonable valuation, you'll probably be better off on concentrated bets. Again, this is not financial advice, just an opinion of a random stranger on the internet. Now, we'd love to hear your thoughts. How relevant is diversification in your investment portfolio? Let us know in the comments down below. If you're interested to hear more from us, subscribe to our channel to get notified every time we release a new video. Gently tap the thumbs up button for the almighty YouTube algorithm. And if you find this helpful, share this with your friends and family. We will see you in the next video.